welcome everybody to the November 2015 edition of the Roundtable. Hopefully, everybody is still passing leftovers and had a fantastic Thanksgiving dinner. I want to give a special shout out to our dear friend from Evansville, Indiana, Kim Butcher. How you doing tonight, Kim?
Just wonderful. I'm trying to get warm because I just flew back from Florida on Saturday after visiting my parents, and I'll shout out and say happy anniversary to them because it's 58 years today.
Fantastic. Man, that's definitely some long-term stuff. And sorry you had to come back and after your blood was thinned. And then
It
also
is.
Also, we're joined here tonight by Ken Kavula, one of the leaders in the Mid-Michigan and in fact the whole Michigan area, national educator. And I understand Ken cooked two Thanksgiving dinners this past week.
Absolutely, Mark. I practiced once last Sunday and then did the real thing on Thursdays. So I'm turkeyed out, let me tell you.
All
We
right.
have one small container of squash left that I'll send down to you, Mark, okay?
All right, and Hugh McManus he sends his best holiday greetings to everybody, but he is in a brand new project or assignment, whatever you want to call it, and he happens to be traveling probably right overhead right now, traveling to Boston tonight. So he's unable to join us, but he does really hope to make the next one. So, and my name is Mark Robertson. I am founder and managing partner of Manifest Investing, and we help to put this together with the Mid Michigan chapter. We do this for you guys, and we do it for the chapters all across the country. There are guests here from one coast to the other, uh, and from the north to the south, and we do appreciate that. Tonight's program is focused a tiny bit on what we're going to call one-hit wonders. You'll see when we get into the discussion of the portfolio how we spend a fair amount of time on the repeat selections because they capture the most attention, but we also want to spend some time looking at those selections that have been just done just once, one-time selections as we get going. Let's go ahead and get some of the official stuff out of the way. Again, if you're here as a returning attendee, big hugs. Even bigger hugs if you're here for the first time. Everything that we do here is a demonstration of a philosophy or a process, a method of analyzing stocks. The simple formula is identifying high quality companies and assuming ownership when they're on sale. And the techniques that we demonstrate here are focused on precisely that. No recommendation is ever intended at any of these programs. If you do, if you or you have a friend that wants to be added to a reminder list about the session, we do this once a month. They're generally on Tuesday evenings, but sometimes we do float them around. Like tonight, we did switch to Monday. But you can send a note to nkavula1 at comcast.net, just like it says down at the bottom. If you do have any follow-up questions, feel free to send them to me, Mark R. at manifestinvesting.com. Well, here's our standing agenda. We've been doing this for about 5.5 years. We basically want to say welcome. We're going to go through a quick reminder of what we are trying to do here. It really revolves around nothing more complicated than the sharing of ideas and exploring these methods. Don't really have a challenge tonight. Cash America maybe fits that bill a little bit, but I think we'll probably skip over that. We don't really need to get too deep into that. And then we do have 3 stock presentations, PayPal, Protolabs, and Maximus. And we almost always have an audience poll where the audience is asked to vote. Again, even if you're here for the first time, even if this stuff is new to you, you're welcome to cast a vote, especially if you're voting for my nomination. I was kidding. That was kind of a joke. All right, this is what we're here to do. And the 3 of us, and he would be adding a 4th if you were able to join us, are just going to talk about one of the things that we're studying these days. Highlighted as a single favorite investment opportunity. A lot of times we show where we get these ideas from, but we really want to flash those out there, and we do keep track. Most of the selections that you're going to hear from us are going to be core selections, up, straight, and parallel, very stable, established companies. But every once in a while we get playful. Hugh McManus has selected companies like Staples, Bank of America back when it was really beat to a pulp. Kim's selection tonight is a little bit playful, but certainly has the formation of core type characteristics down the road. We do want to beat the market, with the collective portfolio over time. We'll take a look at that. Here's a look at the longer term performance. Every month we basically put another dot on this map. Our long-term goal is to try to beat the market by 5 percentage points. That's 500 basis points. And that's where the red line is on here. Years of operation, about 5.5. And you can see relative return. Again, relative return is just the difference between the actual return of the portfolio versus what would have been done in a mirroring investment in the Wilshire 5000 as a benchmark. So you can see we're up in that 2 to 3% better than the market range, which is actually pretty rare air. We'd like to get up to 5 or higher if we can, but we're certainly satisfied or excited that we have drifted up into positive relative return territory. Nearly 60% of the selections have beaten the market since we brought them to you. And that 58.5, that's just simply taking a look at how any one of the selections is done compared versus the market. You'll see more on that when we talk about the one-hit wonders. Any questions at this point or observations? Other than
yeah, Marty would like you to just take a moment and discuss the basic difference between a core holding and a non-core holding.
Yeah, and it's in the eye of the beholder is what we basically say. A core holding to most of us in the room is going to be a blue chip company, a stalwart company with a fairly long, consistent track record. Core generally is going to mean up, straight, and parallel. Again, generally high quality. Very, very high earnings per share predictability. Non-core is going to be everything else. Companies with a short operating history, companies with a low quality rating, companies that might be doing something slightly unusual. Basically fits more into the category of being more speculative. One of the ones we're going to talk about here in a few minutes is a biotech stock that Hugh brought several months ago that you cannot do a traditional analysis on the company. Ardelyx is the name of the company. And that certainly fits the bill of non-core. I'm not even sure they have earnings yet. Ken, do you happen to know?
I don't think they do, Mark. What I find so interesting, Marty, in this non-core core is that if you start to read the investing manuals from Better Investing, and I have a whole stack of them going back to the late 70s here, you'll notice that the advice has always been to, especially if you have a more mature portfolio, the advice has been always to not be afraid to put 15 or 18 or 20% of your money into non-core holdings. So we're not violating the tenets of Better Investing, and there's nothing that says that you must invest in those kind of stocks. There's plenty of very successful investors that are sticking right to the model, sticking to the up, straight, and parallel model and doing quite well for themselves. But our philosophy has always been much more nuanced than just looking for these railroad track stocks and putting them into a portfolio and then holding them forever.
Yeah, and one of the things that one of the companies that actually is a pretty good example of this right now is Amazon. Amazon is very difficult to chart using earnings simply because they don't care about earnings. They care about cash flow, and that's what they're managing the company to. And Kim will spend some time on cash flow tonight. So, and Kim is an experienced investor. That Kim, you might share some words on what you would think of as non-core, and why you do what you do.
I found that I didn't realize when I first started that sometimes earnings can be manipulated, because just by buying back shares, your earnings go up for a company and it looks great. But I got to that point of cash is king. I want to make sure that they're always got cash in the company and there's always cash falling to the bottom line, so that they can grow organically, which we want a company to do, or if they want to pay me a dividend, they can, and I'll never complain if they're doing that, because that's the cash. They don't have to take out more debt to pay out me a dividend. So I've gotten to be really, I like cash.
Yeah, and just one last thought to kind of close down the subject. If you take a look at Value Line and study it very carefully, they basically substitute cash flow for earnings in all the analysis that they do. They publish all of our PEs and they publish the earnings numbers, but the value line and everything is centered on a price to cash flow analysis. So if you want to dig in a little bit deeper, I would urge you to do so. That does allow them to use the same type of analysis that we use on the traditional up, straight, and parallels. They use them on the cyclicals and again, the less traditional stocks. So again, dig in and take a closer look. So with that, I think we'll switch and take a look at the 20 most influential stocks in the tracking portfolio at this time. Again, to break it down, up at the top of the page is the repeat selection. So for example, Cognizant Technology has been selected mostly by Cy Lynch, who will probably be with us next month. He finishes a milestone point in his education right now. He has selected it quite a few times, probably 10 of the 12 times, but it's been selected 12 times. Every time a company is selected, we invest $1,000 into it. So that means $12,000 has been invested in Cognizant. That $12,000 has grown to become almost $20,000, $19,981.70. So again, $12,000 becoming almost $20,000. So you can see that is the one that's got the most number of selections over the 5.5 year period, doing quite well. Apple checks in at 8 times being selected. 8,000 has grown to 12.9. Down at the bottom, Gentex at 4,288. Well, how many times has Gentex been selected? It shows up as a 4-time selection up here. So again, that helps you to kind of break down how much is actually invested into each one of these positions. You can see that Hugh McManus has gone the non-core route with Amazon here. It's been selected a couple of times, including at our live roundtable at the National Convention in Chicago a couple of years ago. So some very solid performances from top to bottom, some community favorites, and also some pretty special smaller companies that have bubbled to the top. Like I say, I threatened to pick Polaris again and make another repeat selection in Polaris just tonight. Any comments on the portfolio, either from Kim or Ken?
Well, yeah, Mark, if you notice, you don't find Amazon up at the top in the legend up there, which means that it's only been chosen once or twice. So that $4,500 is that's pretty hefty for a single choice or maybe a double choice.
I think it's a couple from you, yeah.
Yeah, there's a couple of companies on this list that only have been chosen once or twice that are on the top list right here.
Mm-hmm.
So when you find those companies, that's even a nicer Easter egg to hunt.
Yeah, and there's some really good ones there. Mesa Labs, for those of you in the audience who may not be familiar with it, Mesa Labs is a much smaller company, but a lot of the very high quality characteristics of companies that we watch for, so we often will point that one out. It's been quite good to a number of us. Qualcomm has us all a little bit disturbed. Those of us that have selected Qualcomm, and there's at least 3, if not 4 of us that have done that, Qualcomm is facing some fairly stiff challenges these days. Yeah, some neat stuff from top to bottom. So let's go ahead and press on and talk about what we're going to refer to as one-hit wonders. These are companies that have been selected just one time during the sessions going back 5.5 years. So that means that just one of us laid them out, whether it was either one of the knights or a guest damsel or a guest knight. And what this also means is the audience did not select it on the night that it was presented. Otherwise, it would have 2 selections and wouldn't qualify as a one-hit wonder. So we're going to be looking at companies that the audience has turned down, to a large measure. But one of the things I find kind of fascinating is 29 out of 50 of them are actually beating the market. That's actually a pretty large number. That's our 60%, our 3 out of 5 number right there, living it out in the one-hit wonders. So 29 out of 50, that's a pretty powerful number. Here's our best performing one-hit wonders. Going back over the years, you'll see that the one that I was talking about a few minutes ago, the biotech company Ardelyx, ticker symbol ARDX, as is shown here, comes from earlier this year. Purchased back in May 26th of this year at 1091. It has basically doubled, gone up 80% during a period when the stock market has actually gone down since May, believe it or not. For a relative return, again, that's just going to be the actual return on the selection Mine is the matching benchmark. That's based on the performance of the Wilshire 5000. We're talking about a 79.9% return since May, and that's pretty special. So you can take a bow at 35,000 feet and hope that that one hangs in there. I suspect that one might be a bit of a roller coaster. It's certainly all the it's definitely a non-core position in the portfolio. Probably does not even have earnings. I haven't looked lately, but probably doesn't have earnings. Just kind of working down the list. I do notice that I am in the number 2 spot there with the best closed out position, and I'm going to have to revel and cherish this moment because it doesn't get better as we go onto the next slide. So we might spend a little bit of time just noticing that my name is on this chart. But Ken, any comments on any of the selections you've made as to how you feel?
Well, we've pretty well trashed Chinese stocks on a regular basis, Mark, but I belong to a model investment club that has owned NetEase probably for the last 5, maybe 5.5 years. And I noticed that Cy picked NetEase back in 2012. It's an internet gaming stock, but kind of a hybrid, but purely a Chinese play. And you can see that it's had a 27% relative return. That's an annualized relative return. That's 27 points above the market. That's pretty decent. The total return for that stock is almost 39% since we put it in the portfolio in February of 2012. So we're approaching 4 years. So not all Chinese stocks turned around and bit you in the butt. There's a few of them that have really done quite well for investors.
No, and I'm thrilled to see that some of our guest knights and guest damsels are on the list here. Matt Spielman with AZZ down there at from July 2013, and Kim, I can vividly remember Kim's selection of Bank of New York Mellon. You want to spend a moment thinking back on that one at all, Kim?
Well, Bank of New York Mellon is, I saw that it was down, and as an investor, we have had drips in our portfolio, and I thought, well, who takes care of these drips? And I found out Bank of New York Mellon did. I thought, and I looked at it, and it was right after the market had gone kerplunk, and I saw where the PE was very, very depressed, and I thought, woo, we've got a Nicholson triple play here. So I'll admit I have that still in my portfolio, and I'm not complaining because in 3 years I've doubled my money.
Kim, don't they handle a lot of the paperwork for ADRs as well?
They do.
Mm-hmm.
And since that's something that I kind of am a simplest, make it, what do I use and what do I like? So, and who takes care of it? So I don't have to. So I kind of look at those kind of things. And I thought, well, if Bank of New York Mellon does this and they can expand, their PE can expand, that means the price of the stock's going to go up, and I'm never going to complain if I double my money in 3 years, 3.5 years.
Mark, I live in a household with my daughter visiting on a regular basis, who continues to remind me that one of the fastest growing medical services anywhere in the world are physical therapy services, whether they're sports related or age related or whatever. The amount of referrals, the number of referrals for physical therapy is just growing exponentially. So looking at a company like US Physical Therapy about 3 years ago was a wise move. Notice that that's about a 34% annualized return with about a 21% relative return. So that's another one that I should have continued to play with rather than just picked it one time and ran away from it then.
Yeah, it's a solid story, and I guess I'll close down this slide with just pointing out a couple of things. Notice the number of 2010 entries on here, right down to the bottom there with Costco Wholesale. These go back to the earliest days of what we're doing here. TJX had one heck of a run. We had a lot of fun figuring out when to try to sell that. I also noticed that Nick Strategos, another guest night, is on here with Rue 21, and that's the right way to do retail. I'm going to show you on the next slide the wrong way to do retail. Um, but the one thing I want you to take away from this slide, there's also a couple of very staunch community favorites. CVS Health is on this list, but just kind of scroll up and down that purchase date column and notice all the 2010s, 2011s, 2012s as I scroll to the next slide, because you'll see a big difference. And the thing I'm going to remind us about is if Silence were here, he would be talking about how sometimes the things that we do take some time. And yeah, I'm setting up an excuse. Here's the next slide for our worst one-hit wonders, and I'll kick things off with the one at the top, Iconics Brands. If you want to go back and listen to a absolutely outstanding, wonderful presentation back in April 2015, earlier this year. The audience didn't vote for it, or it wouldn't be here, so the audience didn't back me up that night either. But this one has dropped 73% for a total loss of 73 on the relative return scale. I got to tell you guys, this is the Brand Management Apparel Company. I thought this one was a slam dunk, sure thing. I really did. I felt really good about that one, and I felt really, really good about the next one. And maybe long term that will be the case, because notice, again, scroll down, let your eyes wander down that purchase date list, and notice that many of these are 2014 to 2015, and Cy Lynch would say sometimes our stuff takes time to germinate and go. But I mean, from top to bottom, those two I thought were really good ideas. I was skeptical and nervous about Atwood Oceanics in the number 3 spot. What are your thoughts on Raven, Ken?
Well, you know, Mark, I used to own Raven a long while ago, and I haven't owned it or really taken much of a look at it in the last couple of years. I know it's very diversified. I know some of the things it does. I know it's been attempting to get out of some of its businesses. It had a big business in rubber balloons and rubberized materials, weather balloons, and it's trying to get out of that particular business. But I don't know very much to say about Raven, except that the SSG doesn't look that bad compared to what the price is actually done on the company itself. I think there's a couple of really, really high quality companies on this list. I still am studying and following Schlumberger. I still believe that this is a great company, and it's going to be one of the first companies, in my opinion, to begin to tell us when the whole oil thing has begun to turn around. I think that it's well managed. It's a huge company. It's positioned throughout the world. So I wouldn't give up on a company like Schlumberger, and maybe when we're looking at this same chart 3 years from now, the turnaround will have occurred with that one and with Atwood Oceanics. I'm a great believer in Atwood and in OII, Oceaneering International, as well. So I'm following and keeping my fingers crossed, Mark.
So yeah, some of these definitely are early. Kim, any thoughts on Western Union? I mean, this is again, make sure we read this in context. This has definitely gained 6% per year. It hasn't kept up with the market, but not exactly the end of the world. Any thoughts on that one longer term, Kim?
Well, the problem that I found with that one was that ultimately they kept adding more and more debt, and they were lousy capital allocators. So when they kept adding so much debt, I recognized that I thought it was going to be a great company to be able to transfer money back and forth and all that, but they've got more competitors out there that are doing it much more efficiently, and those companies and the management team are better capital allocators. So it didn't live up to my expectations.
Well, maybe something we could do with a company like that. We don't have to dig too deep into it now, but go for some type of an alert targeting. You know, pick a level where we would like to exit. If that's the case, maybe revisit it in a quick case study in the future. And that applies to many of these. I mean, notice that I'm getting absolutely murdered when it comes to the retail industry, retail sector. And it's actually a living example of why so many of us are have a hard time with the retail sector. Urban Outfitters is an extremely high quality company, but even they have stumbled here pretty dramatically this year.
Mark, we're getting a question from Kelly, and I think it goes to the core of what we're trying to do here. We're not trying to show an actual portfolio. Rather, we're trying to play a game with a tracking portfolio. Kelly wants to know when do you decide whether or not to keep holding some of these really poor performers. If we were actually building a portfolio, I doubt whether we would have kept a lot of these stocks in this whatever we want to call it, this tracking portfolio. But we're not building an actual portfolio, are we?
No, and what it really does come down to, we do watch the overall condition of the portfolio. If I back up a couple of slides, down at the bottom, we actually do have a return forecast, which we would like to be at about 12 right now. We're just short of that. Pretty decent average quality at 84.7. And then we also like to see the overall growth of the portfolio average to be 11. So any company that has that fits the description of weakening any one of those things, and for example, Hawkins I think has a low single digit return forecast right now. Any degradation in quality, and Ken actually pointed this out during the green room period before the session. Raven Industries actually has a deteriorating, definitely weakening quality profile, and that alone can be enough. In fact, it's worth looking at. So I'm going to go ahead and jump out of the presentation and jump over to the website, because Ken picked up on this before we got underway tonight, and I'm going to actually go to my favorite website. We'll go to Raven Industries and let him describe what he sees. And again, in the context of possibly doubling down on a quality company, and again, the quality is not what it was, and here's what he would like to bring everybody's attention.
Yeah, my methodology is to begin with an SSG, a good solid SSG, and then move to Mark's analysis. I can always look at Mark's analysis under one of the studies for a particular company, but I never make a final decision to buy a stock until I look at this particular graph right here. I'm looking at really pretty simple numbers. That red line is showing me par values on a monthly basis, and I like to buy a stock when the par is somewhere near the historic high par for the last 2 or 3 years, but I will never buy a stock when I'm noticing deteriorating quality, and that's the blue line. And notice that for a long while up there, from 2012 all the way through the middle of 2013, we had good solid quality, and then suddenly we get a pretty steady step-by-step drop down, little bit of an uptick at the end here. But I would want to know, why has it gone from a really nice, steady, high quality? Why is it having these problems? Is it having problems because of its finances? Is the earning stability becoming less predictable? What's going on to reduce this quality? Are the profit margins not competing in the industry anymore? Those are the kind of things that quality measures. And when I see declining quality, I just kind of cross it off my list of things to purchase. I'm not interested in companies with declining quality ratings.
Yeah, I would compare it to swimming upstream for a company like this, and that you get tired really fast doing that. So yeah, it's one of the most powerful lessons I've ever learned as an investor is to not to double back down. And I also don't believe there's any type of a time frame. Somebody says it will wait 3 quarters, basically 9 months. I don't think that there is a time frame. I mean, this deterioration's been going on for a couple of years, and it's not showing any signs of abating yet. And I certainly would want to see them get a better handle on. Keep in mind that's an emotional number that covers all the stuff that Ken just talked about. So I think it's worth just kind of reinforcing that here tonight.
Yeah, Mark, Bill would like to know, when do we actually close out a stock? And some examples, Bill, are when we have a stock that's been bought out or been absorbed by another company or has gone private. Those positions are closed out. You saw on both lists, the one-hit wonder lists, you saw some stocks that had yellow in the background. Those were positions that were actually closed out for one reason or another. We also have been trying to discipline ourselves to look at the stocks that are giving us virtually no potential forward return and trying to close those positions out as well. I will tell you, we've been a little bit challenged by one of our night's strategies of buying stocks that are deeply distressed and then holding them for a long time, because the purchase of those deeply distressed stocks plays havoc sometimes with our average numbers, especially when we will make 4 or 5 or 6 purchases of the same company. Witness the Staples holdings. So I think that there are no rules for when we're holding it out. And again, please, this is not an example of a portfolio. This is a set of stocks that we're choosing with specific goals. We're trying to have a large group of stocks that actually beats the market and that has a certain number of winners compared to the market as a whole. Our goal is 2/3 winners and beat the market by 5 points. And I think we've done fairly well in that regard. Joan has her hand up, and I'm going to unmute her. Joan, go ahead. Okay, Joan, you have yourself muted as well. I'm going to guess that that's an inadvertent hand in the air, and I'm going to take it down. Okay, Mark, why don't you continue with the slides? It's just about 9 o'clock at this point.
Yep, we better roll into our stock presentation. But again, just to reinforce the point, even though we don't treat this as completely like a portfolio, we will challenge the companies that have the lowest return forecasts and or deteriorating quality. And that's what Ken is talking about here. Hugh has great faith that the analysts are wrong when it comes to ConocoPhillips, McDonald's, Amazon, and a few others. And his assumptions would be slightly different. It would change those forecasts and actually bump them up. That's a subject we're going to be covering probably in much greater detail in the first and second quarter of next year as we try to bring some other features to life. But again, for any portfolio, if we were going to demonstrate portfolio management concepts, it would be to go in and seek the companies that had the lowest return forecasts and then challenge them. And you do have to treat some of these that are non-core at the top of this list. Again, these are sorted by lowest return forecast to highest. So
yeah, I will say, Mark, that in a real portfolio, stocks that run to the bottom of your return forecast, I would hope entered your portfolio with pars that were well into the sweet spot range, above the market average. And usually in a real portfolio, stocks that you really like that are doing quite well are the ones that gravitate towards the bottom of the par list. The problem is that with Hugh's unique take on the way to invest, and I don't want to criticize anything he's doing because he's wildly successful at doing it, but with his unique take on what companies to purchase, a lot of these par values were right around where they are right now when we put them into the portfolio.
Right, and then the companies start advancing in stock price and their fundamentals get better and stronger, and they basically just sit in those low forecast ranges. So it's a topic we'll look at in greater detail, but the concept is there. I mean, if you want to watch us take care of a portfolio in a more traditional fashion, take a look at Tin Cup. I'll be running the Tin Cup numbers tomorrow morning. That is a more conventional 16 stock portfolio, so that can be done too. All right, let's go ahead and press on here. And we're going to go ahead and launch into Kim's thoughts on PayPal. This is a repeat selection. She brought this one to us a couple of months ago. So take it away, Kim.
Well, thank you, Mark. I am learning how to decipher a spin-off stock. And as many of you know, PayPal was spun off from eBay in July of this year. And this, for me, is a play on the mobile phone mobile market for paying your bills. So it closed today at $35.26. Next slide. And first thing, obviously, you can see that it doesn't have 5 years worth of data. They gave you 3 years of data from the pro forma, from all the documentations I can find on the SEC website when they spun off. Next slide. Yeah. Their third quarter results were reported on October the 28th. And they kind of blew it out of the water. They had revenue growth of 19%, and they had earnings per share growth of 31%. They grew their free cash flow. They're gaining share, and in this kind of a market, what they call that is they grew their total payment volume. How many transactions did they have to process? And that was up 27% in the U.S., and overall the growth was 25% internationally. So they're expanding their customer base. You know, as you recall, eBay started off and had PayPal, and they grew that with the small and the mid-sized merchants. And now they're expanding that customer base, and they're getting into the large customers. They had 173 million. Active users, and they're actually getting those users to increase their transactions. As you can see the year-over-year growth of that payment volume, and if you own the stock, you want them to have more and more volume that they're doing, because that's how we make the money on each transaction. And growth of over 25%, I'm never going to complain about. And as you can see, overall, the mobile growth of this is 42%. Venmo is a division of there, which is person-to-person transaction. So if I have 2 tickets to St. Louis Cards game and Mark wanted to buy the tickets for me because I couldn't go, we would be able to, through an app, he would pay me for those shares from his Venmo account to mine. And that's another area that they're growing into. Next slide. They're expanding their customer base, as I said, from the small and medium-sized customers to the large. They've just added, and they announced Macy's, Symantec, and the company REI. They're adding those, and so that like if you went to Macy's, you could use a credit card, you could use cash, and now you'll also get the opportunity if you want to use PayPal. And as they do that, what's going to happen is they're going to be able to have more interface with the customer, and they can have more rewards services given to them. And that's a great thing for customer loyalty, because I'll admit that I love my credit card that gives me frequent flyer miles to be able to go back to see mom and dad. As I said before, I really like companies that grow their free cash flow. You can see how they've done from in the last year, and they've been growing this overall quite extensively. Their total cash and cash equivalents are $6.7 billion, but $4.3 billion of that is international, and only $2.4 billion is in the U.S. They were going to buy some of that Synchrony credit portfolio, but they're not going to have to. Now, as a company grows free cash flow, they're able to fund their acquisitions, fund their organic growth, and pay out a dividend. And PayPal does not pay out a dividend. They're using all that cash, they have said in their presentations, to make the company grow. Next slide. They have given guidance, and they're following through on that guidance. So if you've had year-over-year growth of 19%, operating margins are going up. They have EPS of going up 31% and free cash flow of 1.3 billion. And when you've got that kind of cash, you can do a lot of things. Next. And this one was this is the first value line that PayPal has been posted. Now I want you to look. The very top line mark, if you can underline that, you can see for 2015, that's $7.55 of revenues per share, and it's going to go out to $12.50. Well, if you add that out, that's almost an increase of 75%. If you look at cash flow of $1.45 to 260, that's not as fast of cash flow growth, but that's still awfully good. Earnings growth of $1 to $2 is 100% return. Now, what I really like here is the capital spending. Capital spending of only going from 60 cents to 70 cents. This tells me that this company is not capital intensive. It is capital generating. So they don't use a whole lot of cash to get the company to grow. They're a cash cow. They keep giving us more and more cash, and that's great. Our book value has been increasing. That's like a 60% growth. Our common shares outstanding is staying pretty much constant. Your operating margins are staying consistent at 24%. Your net profit margins is going from 13 to 16. But if you look, the estimate of that was when they were underneath eBay was only 5.2 the previous year, and they've been able to go all the way up to 16. They don't have they have very little long-term debt because they have taken on, because they bought a company, Voom, VOOM, so they've got a little bit of debt. But when they have a return on total capital of 11.5, shareholder equity of 11.5, and as I had said earlier, they've got no dividends. For me, by looking at the numbers, the math, what is this telling me is that this company, if our stock prices today was at 35.26, and if they can have their revenues grow 75% in 5 years, and they can have their earnings grow 100%, and your profit margins, they can keep that consistent at that. If the market is a voting machine, I hope the market's going to vote that this stock price will go up 75 to 100%. In the third quarter conference call, I listened to it overall, and the mobile growth was 42%, and the mobile growth of the payment volumes was 24% of that, and only last year that was 20%. So that's a growth in the mobile area for PayPal of over 4%. The Venmo volume was up 200%. And the big thing is I think that the biggest thing going forward is that they increase their large merchant mix, as I said earlier, from Macy's, Symantec, and REI, the company. And this is it. They have a backlog. They have not said how the backlog is, but with that kind of a backlog, and they can add more and more merchants, so they can process more and more transactions, that's just like cha-ching, 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 cha-ching. It's just going to keep on growing. And they have announced specifically that in the next quarter, they're going to discuss their capital allocation of the free cash, which will let us know how are they plan on growing the company organically? Do they plan on any acquisitions, or are they going to return any money to shareholders? And as that slide earlier showed you, they have a lot of the extra cash that they have is internationally, so they can grow internationally, and this will be a global company, so we can see as to they may not bring that money back into the U.S. and get taxed on it. They may be having the company grow internationally, and anytime a company can grow for me, that's great. Next slide. In case any of you do cash flows, just a little bit of information. I did this up, and a margin of safety is $16.92 at a price when I did this in the beginning of the month of November was when the stock price was at $26.24. So that margin of safety would be higher, and it said that the intrinsic value was $43. And I know that Marcus and I have talked and said Morningstar feels that the stock price could be worth $42, and Mark will post with this presentation. There's a couple articles I found from Guru Focus on a couple different hedge managers who are adding this PayPal to their stock portfolios, and why they think this company would grow, and how much more they think that the stock price could be going up. So I hope everyone would think that this could be a possible contender to be put in your portfolio.
Thanks, Kim. And with that, we'll move into this I think is a repeat selection for the roundtable also, Ken. Proto Labs. I know you've done a couple of these. No, this one was
I
mine.
featured I featured Proto Labs about a month ago at a stock up for Better Investing, and I really like this stock, and I'm going to do a very abbreviated version of a presentation here and show you why I think Proto Labs is a great addition to a portfolio at this time. If you'll give me the next slide, Mark. I always begin at the company website when I'm looking at a company that I don't know very much about. And I found out that Proto Labs basically operates in three different segments. They do machining, and that means that they do all kinds of cutting and drilling and boring and hollowing out of parts to make plastic and metal parts that look like that yellow part to the left of the slide. They also do injection molding, where you make molds out of various solid materials, and then you squirt liquid metal or plastic or something else that can be turned into a liquid into the mold, again, to make a part. And that's the green part is a good example of that. Then they also do additive manufacturing. It's unusually named. We like to call it 3D printing, and Proto Labs is very careful not to use the term 3D printing. They call it additive manufacturing, where a computer keeps adding material to nothing to make something. And that grid at the right-hand side of the slide is an example of that, what they're trying to put together. They make custom prototypes and low-volume production parts in 15 days or less, and that's featured prominently on the first page of their web page. Next slide, Mark. The services actually have names, and they actually are proprietary services. Notice the shipping can be anywhere from 1 day to 2 weeks or 15 days, and the prices for some of the things start at $95. The proto molding parts are the most expensive, and their prices start at about $1,500. Next slide. I pulled from one of their reports on their webpage their long-term financial model, and you can see the targets that they've set for themselves. They've set revenue growth targets of 25%, margins between 61 and 63%, operating income of about 29% growth. So they're setting quite high growth rates for themselves. And what's amazing is they're hitting these numbers. Next slide. They are driven by proprietary technology, especially in the way that they quote the different prices and the business itself. They have an extremely efficient advanced quote system, relies on software that they've developed, and they can turn around the request for a part in less than an hour. They also have a lot of advanced automated engineering that is unique to what they do, and the software is owned by Proto Labs. And then their centers where they actually make the parts are focused on quick turnaround, and they run numbers of parts, anywhere from 1 to maybe as many as 500 or 600 different parts. And again, using a lot of proprietary business situations and also machines to help speed up the turnaround for these parts that they're making. Next slide. One of the metrics that I find throughout all of their literature is they keep track of the unique product developers and engineers that they serve. They figure that if you can keep increasing the number of unique developers and engineers that you serve, then you have a better chance of serving that person a second time. They find that once a person uses their service, they're usually quite happy to come back and take advantage of the service another time. So they're always focusing on finding other developers and other engineers that have not used their services and getting them into the stable of folks that are using the services. You can see the growth. It's been very, very strong and fairly consistent in an upward direction. Next slide.
Well, Ken, as a former engineer, or I'm still an engineer. I'm kind of having a moment here. I'm very emotional about this slide.
You can see that they really turned the traditional parts prototype parts business on its upside down on its head. To make a 3D CAD part traditionally, it took anywhere from 4 to 12 weeks. Proto-Mold has reduced that time from 1 to 15 days. And I find this sentence all over their website: "We're not your traditional manufacturer." Their goal is to be able to turn around almost any part that you can order in 10 days or less, and they'd love to be able to do it in 5 days or less if at all possible. Again, next slide. I've just touched the top of what this company does. I would urge you, if you're interested in Proto Labs, to go to their website, and on their front page you'll find a block. I've cut it out of the page right here. It says take a tour. I'd click there and I'd spend a half an hour looking at all the different movies and presentations that are on the website. You get a really good feel for what the company does and an excellent feel for what its goals are going forward, how it's going to make money in the future. Click again, Mark. It's only been around publicly for just a little bit less than 4 years now. They'll finish their 4th fiscal year on December 31st. I do have some pro forma numbers from prior to the going public, but I took them off of the SSG and began my SSG with 2012. This is what I like to see. I like to see a company that can take top line revenues and convert them to the same general type of growth in earnings per share. Click again. When I do a traditional SSG, and I'm deliberately not putting down my judgments, you can go to my stock up presentation to see my judgments. It's on the Better Investing website. But when I do the analysis for today's price, actually for this morning's price, I get a return of somewhere in the 14 to 17% range. That's how I like to interpret the PAR and the compounded annual number. I figure that I should be able to sell somewhere in the top half of the PE range, and that means I should be able to turn around 14 to about 17%. That's very, very acceptable from my point of view for a smallish stock like Proto Labs. Click again. Here's that graph that we looked at for Raven Industries, and I like to see a stock that has consistency in quality, and I'm looking for the last year and a half or so. In fact, going all the way back to October 2013, a few blips every now and then, but for the most part, nice and consistent. And also, I notice that that red line is up near the historic high for the company. So I would be buying the company somewhere near historic high par values. And again, from my point of view, that's a really good thing. I captured the equity analysis top at the top of this slide. Mark is suggesting the quality is very, very high at 95, and he's suggesting a par value of 21%. Let me show you where his analysis and my analysis differ just a little bit. Click again. Mark has decided to set sales going forward based on the analyst consensus numbers and a little bit of massaging of those numbers. He's decided to set sales rates going forward at about 24%. I've circled it right smack dab in the middle on the top of the slide there. And he's also chosen an average PE ratio of about 32. Going forward. And again, it's based on analyst consensus. That works out to about 21% par value. One more click, Mark. If I substitute my judgments in this same analysis, I've dropped the sales to 20%. I don't disagree with Mark's 24, 25 number, but I'm going to try to be a little bit conservative and see where that leads me. I think 20% is certainly doable for this fast-growing company, and I've dropped my average PE to around 30 instead of the 32. Notice that that knocks the par down to around 15, and that puts it in the same general ballpark as my SSG. It validates my thinking for the company. It reinforces my thinking for the company, and it just tells me that this is something that I think that right now I'd like the opportunity to add to a portfolio. I do own this stock in one portfolio that I manage. I just want everybody to be aware of that, but I do think that this is something that I'd like to add to our tracking portfolio as well. I think that's my last slide, Mark.
Okay. Well, thanks, Ken. Yeah, that's certainly, you got to love the companies that care so much about the engineers. And we probably should point out that this is an example of one of the companies that has come to us out of the Forbes Best Small Company list, which we had to make our own list. Can read more about that at a couple places we'll talk about here in a minute.
Mark, we have a hand in the air from Sharon. I'm going to unmute Sharon and see if she wants to speak. Sharon, go ahead.
Hold on one second. Okay, we just wanted to lower a volume. My question was, what about the competition? Because it is a newer company and a smaller company. What is your competition like?
There's very little competition in this space right now, and with their proprietary software, I think that you'll find that Proto Labs is kind of like the gorilla in the room right now. There's nobody doing as much as they're doing, and if you were to go to the S&P report or their Morningstar front page report, you can find a list of some of the very small companies they compete with. There's not a whole lot of public competition out there to actually measure, however.
Thank you.
Okay.
All right, we'll come back and address any other questions on Proto Labs, and let me just go ahead and wrap up by sharing a couple of things. I'm going to show you where you can find this list so you don't have to jot all these numbers down. Obviously, the presentation will also be available to any Manifest subscriber in our forum. It's already there. This is the Ivory Soap screen where we're basically looking for companies that we might take a quick look at. Chipotle with its troubles kind of jumps off. Illumina's been pretty hot. Cognizant is here. So if Silence were here, he couldn't resist that. He'd probably be adding to Cognizant tonight. But there are some interesting companies on there. Buffalo Wild Wings with their chicken challenges. But from top to bottom, some pretty good stuff. I would caution you, SolarWinds is in the middle of an acquisition, so that one may actually get taken out. Also wanted to point out this one, and Ken, you might take just a moment on this one to explain what we're looking at.
Okay, we've run a stock contest in mid-Michigan for 12 full years. We're in our 13th year of the stock contest, and every year we create a portfolio of the most commonly picked stocks in our contest entries. This is the portfolio for 2015-2016. The contest runs from November 1st to Halloween of the next year. And we have found that this particular portfolio, we call it Your Choice, it's beaten the market on a relative basis 11 out of 12 years of its existence. So we think this is a pretty powerful group of stocks to take a look at. I would suggest that if there are some names on this list that are completely unfamiliar to you, it might be because you're looking at a stock that is known geographically. And the one I'm going to particularly point out is Diplomat Pharmacy. I'm not going to make a big spiel for Diplomat, DPLO, but at the beginning of the contest, we placed $100 in Diplomat, and you can see that right now it's worth $126. The only one to do better than that is Illumina, another stock that I'm really, really sold on right now. Illumina has a great SSG, Diplomat would be definitely a non-core holding, a pretty small um, number of years of history, and a quality rating and earning stability that is almost non-existent at the moment. In other words, it's a initial public offering, but it's been on fire. So I'm just suggesting that because this portfolio has been so powerful, beating the market 11 out of the 12 years that we've put it together, I would suggest there's some great ideas on here to take a look at. And if this portfolio, performs the way that 11 of her 12 brothers have, then this one will be on track to beat the market as well. Mark, you've been to our breakfast a lot of times. Maybe you can add something else to what I had to say there.
Yeah, the only thing I would point out is, again, these are sorted from the ones that have been most successful over the last month. So I would probably be drawn to the ones at the lower half. They're almost all very high quality, but you see Mesa, Cognizant, Polaris, Apple. I would shop at the bottom half of this list because they haven't been quite as hot lately. So some interesting opportunities there.
What's so great about that list, Mark, is that it mirrors what our clubs kind of do when they put a contest entry together. They put 70 or 80 or even 90% of the stocks in good, solid, high-quality stocks, and then they take a flyer on 2 or 3 stocks because, after all, it is a one-year contest and you'd love to win the contest. You can practically pick out the flyers by looking at the 2 low-quality stocks on this particular list.
Absolutely.
Diplomat, and the other one happens to be Bank of the Internet.
Mm-hmm. All right, let's go ahead and wrap things up. My stock presentation won't take too long. It is a repeat selection. One thing I wanted to point out is we have been putting out a list of 5 stocks on Friday evening or over the weekend, and I'm really just looking at companies that have very good long-term prospects. Again, that 5-year constant time horizon, but also factoring in a little bit of short-term sentiment in the context of Morningstar, Standard & Poor's, Goldman Sachs, the analyst consensus, just thinking that you could have some positive price pressure over the next year. Maybe I can have fewer companies end up on that poor performance 1-year list the next time we take a look at it. And, just looking down this list, Polaris kind of jumps out at me. Decent returns, held in favor by all of the major research services. Maximus is also held basically in favor by everybody that covers it, except for Value Line. They tend to be a little bit more pessimistic. Those of you that want to check this out in a little bit more detail, see all these slides. You can go to expectingalpha.com and you can actually pull down these weekly collections of 5 stocks. We will have a tracking portfolio. We'll only put them in there on their first appearance, but you'll be able to at least take a look at some companies that, again, have this duality of good long-term expectations along with pretty decent sentiment for the next year or so. And we'll be doing that. You can check out that down below. As a result of that, here is Maximus. Again, this is a repeat selection. It's a consulting software company that works with probably the best way to put it, healthcare administration software for the federal government, for Canada. They actually have a contract with Saudi Arabia, working on one in the United Kingdom. They are Medicare facilitators, and having gone through Medicare recently with my dad, the software was great. As I sat there with the county agent helping out Dad, I was looking at Maximus software as we were doing that, the website. You see a nice version of Upstraight and Parallel. I don't think the Affordable Care Act is going away anytime soon. It may change in shape or morph or do something, but we're obviously going to have those type of programs and the need to administer them carefully. I would call this Upstraight and Parallel. The stock price has been following the earnings. Fairly rapidly growing company. It's not that big. It's at $2 billion in sales, growing at 18%. Basically pegging that net margin at about 8% with a PE ratio in the high teens to give us that kind of sweet return of 14%-ish for Maximus. And here's a look at just some of that underlying fundamentals. Again, it's pretty easy to come to an 8% net margin forecast, give or take a percent, based on the picture that you see there. And again, as the company has matured, it's actually gained a fair measure of respect over the last several years, but it's fairly easy to give it a PE anywhere in the upper teens or in the 20ish range. So that's what it looks like. Again, from a stock price perspective, it has been quite strong. In some cases, a little bit overheated. As you can see, the green mountain peaks up at the top, but it continues to press on. The stock can stay overbought for a very long time. So can entire markets. But I'm going to go ahead and add another position in Maximus to the plans. The one major threat that they do have is they do have a major contract that they're attempting to win with the United Kingdom that they may or may not. If you're a stakeholder or a stock watcher, you might keep your eye on that situation to see how that's going. So we'll go ahead and add Maximus to the party. So with that, Ken, I think you can go ahead and launch the poll. We'll take care of the audience poll, then we will stick around for questions and answers for a few minutes. These sessions do typically run about 75 minutes, and we're in under that now.
Is that the right slide saying forward
No,
here and below?
Well, that's the.
Oh, no, it's
results
not.
from
It's the
last.
placeholder. Yeah.
It's a placeholder. Ken is putting up the current one now.
I've lost my grab tab here, Mark, so give me just a second, okay?
Yeah, that's the results from last month when I put on an awesome presentation of Forward Air, and you can see I came up short in the audience vote.
Here we go. Polls.
I haven't made it yet once. But the last time I did it, I got as high as 35%.
Well, I'm going to start inviting my mom and my brothers and sisters and.
Okay, I'm sorry it took so long there. Here we are, okay?
And I'm going to enter the room under an alias and get to vote one of these times too.
If you just take your mouse, folks, and choose one of these, or choose none of them, we're up to 60% voting, 75% voting. We have a horse race going here, 80%.
Maximus is pulling ahead?
No, it's not. 85%.
It's not?
No.
Oh, man. You guys realize that Santa watches this.
About 2 more seconds here, folks. If you haven't voted, give us a... Okay, I'm going to close the poll. And I'm going to share the results.
Oh, man.
And you'll see that PayPal just inched out Proto Labs. So, Kim, you have your first audience choice here.
Well, I do want to warn the audience that I'm going to have Kurt do an XML export of the people who voted against me, and they will go onto the Santa naughty list.
Mark, I'm going to be away from the keyboard for just a moment.
Okay. But we'll go ahead and enter those results. And Kim, you're going to have a double entry for PayPal tonight.
Woo!
All right. While Ken is away, let's go ahead and just talk about some of the things we're going to be doing here in the next short time frame. Ken and I will be in Chicago, Orland Park specifically, for a little bit of a roll up the sleeves workshop, face-to-face workshop, doing some of the stuff we were talking about here tonight. But next Wednesday, December 9th, if you live in the Chicago area and would be interested in that, drop me an email. We'll have an event listing out, and we're working with, obviously, the Chicago chapter of NAIC to put that program on. There won't be a lot of seats, but we'll have some fun. It will be at ITT University down in the Orland Park area. It's an area we've been in before for programs. There's also going to be the next roundtable will be December 29th. I believe that's a Tuesday, and we'll do it at 8:30 p.m. I just wanted to make sure everybody's aware that the NAIC National Convention is near Washington, D.C. this year. In May, we'll add the dates to this, but you just want to pencil that in and watch for May. All of us will be there. Kim, I assume you're going to be at the National Convention also.
Yes, I'll be there.
So we'll be there presenting classes and just sharing some time with all of you that can make it to that event, and a lot of fun. Ken, did you want to say something about the Flint Baker BI Tools workshop? Are you back? He's still away. I believe that's a Saturday morning. It's at the same location that one of the model clubs for the Mid-Michigan chapter holds its event.
Yeah, Mark, I'm back, and it's a free workshop, folks. We just need you to call and reserve a seat or drop me an email to reserve a seat. It'll go from 9 till noon. Bring your laptop, and we'll be doing hands-on with the BI tools, the SSG Plus, the core SSG, and the new stock comparison guide from the online tools. So if you're anywhere near Baker College in Flint, join us if you need directions. It's on our website, the Mid-Michigan website, on the BI website.
And one other thing we might add, we were talking about it in the green room before we got started. Probably Saturday morning, December 19th, we'll probably have one of our open microphone, open keyboard sessions where we basically spend a good part of the morning just talking about anything that might be on your mind or you want to see demonstrated. So watch for that in the events listing also. And I guess with that, I just have to say I hope everybody has a great holiday season and a Merry Christmas. And thank you very much, Kim, for participating and contributing here tonight.